174.90
Uh-huh.
because I was looking at foundation price and I looked a couple days before and it seemed like it was right there. So I thought if it broke that, it will start shooting up, which is which it did. But I also put sell order 60 cents lower, like a limit order,
Uh-huh.
um, just in case, because I like to do that. I like to have my stuff ready.
Mm-hmm.
But as soon as I put my limit order, it got filled.
Okay.
I'm like, what? And both were closed, and it showed a $14 profit. I'm like, what the heck happened there?
Okay, that's strange. You said you were trading Facebook?
Yeah. Oh no, sorry, Baba.
Okay, Baba. Okay, yeah. So, hmm.
Yeah, weird. They both got filled, although the other one, the sell was a limit order,
Uh-huh.
and it was like 70, 80 cents above that price. I have no idea why it said failed right away as soon as I clicked. Maybe I clicked something I shouldn't have, but either way, both got closed and it shows 14 total PNL. I'm like, what?
Okay. The next time when something like that happens, please let me know right away or inform me or the team, and we can always dig into the trade. So I'm gonna have my colleague look into that position after the class, and hopefully we can come back and get you an answer about what's wrong, right? Because that does sound a little bit strange.
Yeah, totally.
Okay. Um. Anyways, have you been trading more lately, Luke?
I try to trade every day
Uh-huh.
a little bit to get familiar, but yesterday I traded and I lost some money again. I'm like, okay.
Okay. Well, losing's part of the game, right? I mean, we all get punched in the face. It's how we deal with it that helps us grow as a trader. So it's very important to understand that we're trying to increase our probabilities of winning trades, but there's by no means that you're gonna be 100% probability of making profitable trades on every execution.
Kind of way.
Yeah, I mean, in the perfect world, we'd all want to do 100%, but I have never met anybody in my trading career, and in my life that has a 100% execution record of always making money.
That would be that would be awesome. I want to
Yeah,
know the guy.
yeah, yeah, definitely. I'd like to give him some money to trade for me, or learn the secrets of the 100% execution rate, successful
Yeah,
execution rate. You know what I mean?
yeah, would be awesome.
Okay. Are you ready to get started? Are you guys ready to get started? Yes? No?
Yes, for me, but
Yeah? Okay. I did see your homework and I was able to add it here. Um, oh, okay, so I guess we're all ready to go. Eric is good too. And yeah, so luckily Eric was able to provide some contributions too, which is always nice. The more we have contributing, the better. But anyways, let's start off with critiques of your homework, Luke. Oh, okay. I see Khaled just joined us. Khaled, nice of you to join us. Anyways, so we are about to get started, Khaled. You haven't missed much. We're just taking up the homework. Anyways, Luke, do you want to kind of walk us through here on your thought process for Fibonacci's? I believe this is. I see a lot of levels here, so
yeah,
a lot of lines, a lot of levels, but I think these are primarily Fibonacci's.
yeah.
Okay, yeah. So please go ahead.
Okay, so I set. Um, can I take over the
Yeah, sure,
channel
of
or
course.
the oh,
There you go.
I was looking for the low and the high of that particular session that day,
Yep.
and so I plotted it from bottom to top right there, and then it drew some lines for me.
Hmm.
All those lines you can see. So what I've done is try to show the levels. I
Yeah.
drew some lines here, here, and here to
Yeah.
show those areas here and
Yeah.
here. And
Yeah. Definitely.
it was interesting to see.
Yeah, absolutely. And I want to point out one fact here is that up here in the top left-hand corner, you have dailies, right? So you're actually looking at a daily chart, meaning that each one of these candles represents the entire day's price action, right? So
That's right.
so your Fibonacci's that you have drawn here is showing us maybe what has happened in the last 2 weeks or so.
Or more than that, right?
Yep. Yeah. I would say about, well, let me see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So 11 candles. So about 2 weeks worth of trading activity, right? And just to give you a little bit of context, that gap there, I don't know if you remembered. I'm gonna let me take over for a second here. That gap there. Let's give me 1 second here. So this gap here that starts up here. Oops, let me change that. This gap here that started up here, right? That was
They're
actual.
not the,
Do you remember?
yeah, they're not the first time like a traded company reached $1 trillion or something, right? Isn't it?
Yeah, so this was leading into the earnings report, right? So you remember the whole story of Apple becoming the first trillion-dollar company, right? And going into this earnings report, you see Apple gap up to here, and then started trading at that magical, I believe it was $207 or so that made Apple a trillion-dollar company. But but what I want to say here is that you use some very good reference points, right? And by reference points, what I'm referring to is this. So this is the all-time high that Apple has traded, and this here was leading into the earnings, or you would even say that it is around the earnings mark, right? And so using this time frame here, using this time frame here as a benchmark to set your Fibonacci's is a very good strategy or good point of anchor to set that, because as soon as you drew your Fibonacci's from here, I mean, we have some very distinct levels here where the market does show some signs of significant levels for the pricing, right?
And all of them, that's funny. Like each level shows something somewhere crazy.
Right. It's very interesting when you use Fibonacci's in this context. Okay. So anything else you want to add to this, Luke?
That's, that's all
No?
I wanted for Apple.
Okay, let's take a look at another one here, Alibaba. And okay, I'm gonna pass this over to you again, and you can go ahead and discuss your thought process here.
So this time I changed the time frame to 5 minutes.
Yes.
Just want to try different time something. So I looked at a significant gap before I plotted the Fibonacci, and when I saw one, I just put it on the top,
Mm-hmm.
stretch it to the lowest of that day, and just look what it gave me. It gave me really good lines again at the 2.3282 and a half.
Mm-hmm.
Stretch. So you can see the levels here and the bottom, all these pricing things right
Mm-hmm.
on the line, and again at the half, and again. And sweet.
Yeah, yeah. So those are some excellent reference points here, and again, I just want to mention that when we start to learn about market profile, which I believe we may start next week, is that in market profile, two things that I've noticed with regards to your chart and how it relates to market profile. number one, you use 5 minute candles. Okay, so let me take that from you again here to make some context to things. 5 minute candles, meaning each one of these candles represents 5 minutes. Secondly, you were able to identify the gap and where the market traded, or where the market essentially the highs from since the market opened. Next thing I like is that you were able to identify the lows, right? And in market profile, when we are looking at trading the markets, we are using the highs and lows of the days as reference points for whether or not we are going to be experiencing a sideways ranging market. So a market that goes sideways like this. In this case, the Fibonacci's really showed a strong sideways conviction, especially especially within these levels here, right? So that's a nice thing to do. All right. The other thing that I want to mention that relates to market profile is that market profile states that the days will either be sideways or you will experience a day type where a high and a low is established and then the market comes back and reverses and breaks through one of these highs or these low levels, or you can experience something like this where the market creates and establishes a high, establishes a low. You'll experience a bounce back, and then the market will come and break through these levels and then establish a trend. Right, so these are essentially the three strong day types that we're going to be experiencing when we see market profile, and using Fibonacci's, especially when there's a large gap like this, could really help to identify one, where the market will likely bounce, the initial bounce within the market profile, and two, whether or not the market will either be a sideways ranging day, a reversal day type, or a trending day type. Okay. All right. So let's move on to the next one, and here you have Facebook at 1 minute. So I'm gonna pass that back over to you if you want to do anything while you're explaining yourself.
Mm, I would look for the high and the low,
Yep.
plotted it, and then looked at the Fibonacci levels.
Mm-hmm.
Then I drew lines where I could see significant areas where the price would just bounce off,
Okay.
was this one and this one.
Okay. Yeah. All right. Anything else you want to add to that?
No,
No? Okay, so let's move on to the next one. Okay, go ahead.
You are now muted.
another Facebook, just on a different time frame. This one is 30 minutes, and I
You are
stretched
now
it
unmuted.
again from uh, high and the low of the day, and I drew the lines one more time.
Okay. Okay.
Again, you can see how the price touches the line and bounces it off.
Yeah. Yeah, absolutely. Especially when you're seeing that level there, which I believe is the one was that the 60 61.
Right? Yeah.
Yeah, so
On the top one is at
yeah, so no,
78.50.
I'm referring to this level right here.
At 78.
Yeah, 78. Sorry. So yeah, I mean, even this one, you can see here how the market has bounced off this like several times, right?
Yeah.
Yeah. So again, very, 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 very good. I think you're really getting the hang of drawing your Fibonacci's, right? And
That's 15 minutes.
okay, yeah, yeah, you 15 minute here. Yeah. So what I'm getting out of this is that you're seeing a lot of like 78s and 23s, right? Or even this one, the 38s and the 61s. Acting as like a very strong support to resistance level when you're using your Fibonacci's. hmm Okay. And
Oh, I sent you as well, huh?
I'm sorry.
Did I send you that one too?
Yeah. So I think you sent me about like 6 or 7 of them. So I think this may be the
Wow,
last one.
sorry about that.
No, 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 it's okay. I mean, by all means, I encourage you sending me this because number one, it it gives me the ability to see your thought process, and number two, we can kind of analyze and critique your thought process and ensure that you developed the ability to draw your Fibonacci's accurately, right? And I think it's very important to go through these steps um, because it allows us to analyze this. Okay, so yeah, go ahead if you want to, talk about this.
It's just another stock menu on the 1 hour time frame,
Uh-huh.
and I saw that they red candles, so I decided to it's just that one candle I
Okay.
used to check matching out because the top and the bottom was like the high and the low of the one day, so
hmm
might as well.
hmm Now,
And then
so
to the
I
lines of the
so for this, I would assume that this is the day that we're looking at, correct? Like all these candles
yeah,
here.
but
Yeah.
yeah, I think I stretched it only using the. I don't remember where I took the top and bottom. It's not showing
Okay.
here. Oh, I think it's just
Yeah. So I don't see the top accurately, but I can see that you drew this as your bottom, correct?
yeah.
Yeah. And so was this your top? This one here your top, or over here?
No, I may actually have used it all the way. See that peak? If you go back in the middle of the screen, the very top there.
Here. So I'm gonna pass it over to you, and you can show me.
I may actually have used this right there.
Oh, really?
I'm not sure.
Oh,
I think it was one of my first ones, but I can't remember.
okay.
Sorry.
Okay, yeah. So this one, I really don't see the other Fibonacci level there or the anchor point up there. But yeah, I
Yeah,
mean,
maybe.
if you were to draw this, let's say, if you were to do this and this as your anchor points, I would argue why not here, right?
Yeah, so I probably didn't do that. I think I just used that big candle and that's
Okay.
your first
Yeah,
candle.
so I just want to mention that, like when you're drawing Fibonacci's, guys, you must be using points that represent anchors, right? Good anchor points. And so good anchor points could be the all-time highs, the all-time lows, the highs of the days, the lows of the day, that type of thing. You don't want to be using arbitrary candles or price lines that happen during, like, a 15-minute time frame as anchor points, right? So hopefully that makes a little bit more sense. If this here represents the high of the day, then that would be a valid anchor point to use. And if that represents the low of the day, then that would be a valid anchor point to use. But you don't want to be using Fibonacci's on like these 2 points here just because it's a big candle, right? Now, granted that if this was a significant move in the markets, let's say, for example, you've got a big headline that just came out at whatever time, and this is causing the markets to move because this news headlines is now affecting the price, then that time frame when you use your Fibonacci's as two anchor points would make more sense. Okay? Any questions, guys? Okay. So let's okay. Okay, yeah, no, we just have one more from you, Luke. Okay, so
Let's see.
okay, so is this a wait, okay, so is this a zoomed in picture of this?
Um,
This is 1 hour. Did you do this?
yeah. And
Okay, so now we get a little bit more context.
there you go.
Okay.
Yeah, it's the same thing, but now it's zoomed in on the 5 minutes as opposed
Okay,
to the
okay,
1 hour.
perfect. Okay, okay, perfect, perfect. So now we can critique this. So I like this because this was the low of the day. This here, I can tell you, from my experience, is not completely valid as a top anchor point because you can make the argument that this here was the high of the day and that you should be using your Fibonacci's from here to here, right? Rather than
But look,
from this point.
there's a, if you look at the bottom, it says the 14th. So that's the beginning of the day. That's why I took the top of that candle because it was a new day. Was I wrong?
Oh, let me see. The 14th. Oh wait, yeah, actually no, I think you're correct. This here. Oh wait, yeah, yeah, okay, yeah. So my apologies. Yes, my apologies, my apologies. So I'm losing my bearings a little bit here, but if I understand this correctly,
Yeah. I was just
this
going by the actual
yeah,
day.
so this is one trading day up to here,
Yeah,
and this is the next trading day
starting
from
at the
here
candle.
to here.
That's right.
Okay, okay. So yeah, so if that is the case, then yes, you are correct, and my apologies for that mistake. I wasn't able to see. I thought that was just one. I thought this was just one continuous time period here, from here to here. But I do see now that it is a broken down. So that's one day, that's the next day. So yes, in this specific case, then yes, you are correct. That is a valid point here because you're using that top bar there as your reference point, right?
Hmm.
And that bottom level there as your reference points. And so yes, that is much more valid anchoring for your Fibonacci's.
Does that
Okay,
mean I'll be coach someday?
what's that?
Does that mean I can be a coach someday?
Oh yeah, for sure, for sure. Especially if you're able to spot these little mistakes, such as not being able to identify the proper time frame for the day here, from here to here,
Nice.
right? Okay, so moving on. So Eric was able to provide us with um, some homework material that I asked him. Eric, if you're there, can you tell us a little bit about these Bollinger Bands and what you're using here as your standard of deviations? Like these seem like very typical Bollinger Band instruments. Like, are you using the standard two deviation Bollinger Bands? Yeah, okay. Okay, yeah. And so, again, I just want to explain a little bit with the Bollinger Bands is that when the Bollinger Bands squeeze in tight like this, right, that usually typically signals that the volatility is tightening, right? And so it typically means consolidation within the markets. And when the bands widen, right, that's when you see the markets break out. So as you can see here, as the markets widen or as the markets began to pick up in volatility, you can see that the bands widen a little bit. Now, I can probably see why you thought this was a good one, but I can tell you that this here is very common because this is the gap opening. So this particular area where you see the price closing here the previous day and then opening here the next day, it will always cause the Bollinger Bands to experience this large level of volatility within the bands. And this always happens it happens during the day. And unfortunately for us, it's very difficult to take advantage of a move like this because we basically cannot hold trades overnight in the Toro Challenge. And not only that, but this is very common from when the markets close and when the markets open, in the sense that the markets will typically create a gap, and that gap uses the previous day's number and the new day's number to calculate this Bollinger Band. And because the deviations will always be large, you will always experience this heightened level of volatility, or an enlarged band within the Bollingers. Okay, you guys follow? Yeah, Eric. Yeah, Eric. Eric, do you follow? Luke, Luke, I know you. I just heard you. Awesome. And then I believe this is the last one before we get started. Um, Eric, can you tell us a little bit what you did here? These look like moving averages, correct? Yeah. So can you tell us a little bit about the moving average numbers that you were using? So, oh, okay. So I see you're using it's the 5 period moving average and the 10 period moving average. So I can say that, looking at this, the 5 period moving average will typically hug the charts or hug the candles quite a bit here. And the 10 period moving average will typically be a little bit further off from the candles. But again, your moving averages, they do give us a sense of dynamic support and resistance, right? And so as you see in the markets, especially here and here, how the markets kind of kept following these the trends in the market. So the moving averages are still increasing and acting as levels for when you want to enter the markets. Right, so that's why when you're looking at moving averages like this, it's important to understand that they serve as dynamic support and resistance, meaning that they will constantly change, but they also help to validate the direction that you're trading in the markets. Okay, so thank you very much, Luke and Eric, for participating in the homework. Khalid, you're always encouraged to send us some homework. We'd love to hear more from you and give you additional feedback. But anyways, guys, let's move forward with today's lesson, and hopefully we can learn a little bit more about trading and trading psychology in today. All right, you guys ready to get started? Perfect. So today is module 7, and in module 7, we are going to discuss risk management and the trading psychology of most traders. This is a very important topic that often gets overlooked, and the reason why it often gets overlooked is because most people, when it comes to trading, really only care about the execution or the analysis of a trade. They're often analyzing charts, they're often analyzing what's going on in the markets, but they typically overlook the analysis of their own risk management and the analysis of their own psychological well being, right? And these two things can affect trading and trading behavior, and they will either make or break a good trader or a bad trader, right? And so it's important to understand these concepts. And in today, we're going to talk more about how to properly manage risk and how to properly manage our psychology. And various types of risk in the markets, and various ways to overcome psychological behaviors that can set us up for success. So, on today's agenda, we're going to be talking about the psychologies of trading. We're going to be talking about emotional management, and we're going to be talking about risk management. So the three rules of trading that you need to understand. Number one, do not lose money. I think we can all attest to this, is that the longevity of your trading career essentially boils down to not losing more money than you make. Right? I mean, if we are losing more money than the money we are making, then obviously something is wrong here and we'll never succeed as a trader. So we can always say that the first golden rule of trading is to not lose money. Rule number two is to see rule number one. And rule number three is to go back and read rule number two. All right. So the golden rule of trading is to not lose money at all. Okay. So that's
Mhm.
why, Robert,
Possible.
when you said that you made $14 today because of a glitch, so be it. You know, glitches happen in the markets as long as you walked away without losing money. Correct?
Yeah.
Okay. So qualities of a successful trader. All right. Traders need to be emotionally balanced. And by emotionally balanced, what we're talking about here is that you must have, positive relationships with your family. Like when you're embarking in trading, if you have the support of your family, that would really help. I've come across traders you know, who've lost money on several occasions, and when they tell their family that they still want to trade, they still want to trade, their family becomes unsupportive of their desire to trade because of their inability to succeed. And not only does this kind of holds them back emotionally, but it also casts a subconscious negativity within their actual trading behaviors and their trading execution because they do not have the support network needed to help them create an emotional balance within their life. So for you guys, it's important. It's very important to have things such as like family support in the choices that you make, right? So I know, Luke, for you, your wife was supportive of this endeavor, uh, even though you were not successful as a forex trader, correct?
That's correct. She's 100% behind me. She believes in me. She says takes 10,000 hours to be a master at anything, so go for it. I believe in you. She's awesome.
That's amazing. And I hope for some of the other guys, you guys have that level of support that Luke has at home because it is critical, absolutely critical, especially for your subconscious mind, that when you start trading in the markets, you don't have any negative emotions that you're carrying on as you're executing trades in the market. Okay, so the next quality is competitiveness. I don't know about you guys, but when I trade in the markets, I always look at how eager I am to start trading, how I compare to some of the other traders, how what other traders are doing, and how I can essentially increase my points. And this comes far back from when I was very young and I used to be active in sports. I was a big football fan. And by football, I meant North American soccer. So I was highly into team sports such as soccer, and we would play all around the cities against various schools and whatnot. And it was something that I truly enjoyed, and it really built that competitive nature within myself. And so I don't know if you guys can share a story that can relate, but being competitive within trading is very important because all traders to a certain extent are competing not only against their benchmarks and their peers, but they're also competing against themselves, right? I don't know how you would describe your level of competitiveness, Luke.
I do like to win, but if I lose, it's fine because I know I'll just win soon enough, anyways.
That's a great attitude. That's a great attitude, right? And it's that that resilience to not quit, right? And that resilience to always come back and remain in the game is very important for a healthy mindset of a good trader. Okay, so just moving on here, open-mindedness and seeking new experiences. So being open-minded to trying new things, trying new indicators, learning about new things, reading new things in the markets always help. When I first started, and because I came with a university degree in fundamentals of the markets, I was very heavily on the fundamental side of the markets, and when I tried to apply that to trading, it did not work out well for me because oftentimes my views for how fundamental drivers are affecting the market would be broader market moving themes that would have a longer term implication in the markets or would take longer in the markets to play out. And when I approach trading, which is more short term, that disconnect between my educational backgrounds and my views towards the markets held me from succeeding in day trading the markets. And so this was something that I had to relearn and overcome once I was able to consciously think about the mistakes that I was making and not understanding how my bias and not being open-minded is really affecting my performance. So this is something that's very, very important to. I encourage all of you to keep an open mind when you're trading, try new things. Again, another example of this is that I was heavily, heavily against using indicators when I first started. I always felt that there isn't no magical tool that could, lead you to a road of massive financial success just by implementing an indicator and executing orders when the indicator tells you to. And so I was very resistant against that, but over time I have come to have an appreciation for some indicators and whatnot. The next point here is calculated risk takers. They're not gamblers, they're risk takers. So you always think in terms of probabilities, right? Everything you do, you always think in terms of probabilities. When you're crossing the street, when you're jaywalking, what is a probability of a car running you over? What is a probability of an officer pulling you over and giving you a ticket for jaywalking, right? Everything we do in life, big or small, has some type of inherent risk. And as traders, we always need to think systematically about what are the probabilities that leads to winning or losing hands when executing trades in the markets. Right? This becomes very, very important to understand the concept of calculated risk taking. But in addition to that, the ability to quickly calculate risk on the fly because the markets move really fast and we need to execute trades really fast. So we need to be able to calculate the probabilities of certain trades um, very fast and then execute the trades. And this becomes something that gets easier with time and experience. Whole brain thinkers means that you basically try to conceptualize the bigger picture, right? Try to understand the bigger picture, the macro picture, and then kind of like hone in and then execute with a plan, right? And this is why I always mention from the beginning of our sessions together that when you're analyzing the markets, you always want to take a look at what's going on in the broader scheme of things. And then as you narrow in the information, that is when you want to start thinking about how do you set up trades, how do you enter trades, how do you set up risk reward so that when you enter a trade, it is optimal. That is what is meant by a whole brain thinker. All right. Extroverted. So extroverted people versus introverts. So extroverts tend to be more outgoing, more lively, more chatty. In my experience, people who are extroverts, people who are more looking for new experience, looking to meet new people, they tend to be slightly more common in trading. I wouldn't say that they are better in trading, they are just more common in trading. right? I do know some introverts that do very well, and the introverts are the people who tend to keep to themselves. Um, Maybe a lot of introverts are the people who are running, large, sophisticated funds because they tend to keep their strategies to themselves. Who knows? But for the most part, day traders that I've come across, they tend to be more extroverted people. Okay. Patience. So those who trade in the markets can exhibit tremendous amount of patience, waiting and waiting and waiting, patiently waiting for a trade to come to them. They are not actively seeking to get in the markets. They preconceptualize when they want to execute trades in the markets, and they just sit back and wait for it, and then they execute. That is what is meant by patience. Discipline. Discipline is the ability to take a losing trade and not jump back in the markets right away because we feel like we've just been hit, and so we need to hit back. We feel like we've just lost money, so we need to make our money back right away. Even though there isn't a trade to be put on in the markets, we are proven wrong on our previous trade, and our ability to be disciplined tells us that this is not something that we want to be involved in right now because the market is not great, the environment is not great, we got defeated, and so we're going to sit back and we're going to wait for the next trade to come. And that is what you mean by exhibiting discipline within the markets, the ability to walk away from a trade because it doesn't play out the way we had intended to. Confidence. So confident traders are traders who are able to really understand the trade setups that they are going with. They understand the risk and rewards that they're going with. They have a bit of experience that they can rely on, and based upon their experience, they are confident they are able to execute on the trade and be able to make money from the trade. All right. And then last but not least, independence. Most people who are trading the markets like a level of independence. They like to have the ability to control their own trades, control their own destinies. They make what they kill in the markets, as the saying goes. And so these are the qualities that most traders exhibit, right? Can you relate to any of these qualities? Um, Eric, Luke, Khalid, are any of you able to relate to any of these qualities here? Hello? Okay, Eric. Eric. So in the army, Eric, you're probably exhibiting a lot of discipline and confidence. Um, you're probably very extroverted at this point, right? These are all very good qualities of a trader. Um, Luke, unfortunately, Luke, you've lost audio, so that's all right. If you can get your audio setting again, back up again, Luke, that would be great. If not, that's okay. We'll just move forward from here. So the psychologies of trading. So it basically boils down to emotional management and stress management, guys. That's what it boils down to. These two things. Emotional management. Here's a quote from Frank Herbert. I must not fear. Fear is the mind killer. Right. So when you're afraid in the markets, that will cognitively block your ability to think about setting up successful trades. So when we trade, we must overcome the fear of trading. Right. And I can give you guys an example way back when I was a new trader, right? I can tell you that when I first started trading, the back when I was about 17 years old, the very first trade I put on, I was so nervous that my hands were shaking, and it was so hard for me to sit in front of the screen and watch my P&L in the futures market fluctuate up and down hundreds of dollars every time the market moves up or down one or two ticks, right? And this was something that was very, very stressful for me, and very hard for me to take in at the time. Like I was shaking really hard, my heart was beating, it was racing really fast, and it was very difficult for me to sit in front of the screen and watch the price action. And when I finally closed a trade, I realized I was only in the trade for maybe about 45 seconds, which felt like an eternity at the time. Right. And so I was a little bit afraid of the markets, I may say, at the time. But over the years, I was able to essentially train myself to the point where I would be able to monitor the markets while having trades on and remain very calm, very disciplined, almost kind of like a Zen-like approach to the markets, right? And so this was something that I had to overcome in order to succeed as a trader. And so this is something that a lot of you may experience with the challenges of trading, and you all need to find coping mechanisms that will help you get over these. So emotional management. So it's one of the biggest sources of risk in trading. Many successful traders agree that emotional management is absolutely critical. As I mentioned before, having the support of your family, having the support of your friends, these are all things that will help you develop proper emotional management. Trading is more related to attitude and belief systems and intelligence. So you must have a positive attitude about your ability to trade the markets. You must have strong beliefs that you are able to succeed in the markets. I cannot tell you how often I come across traders who keep saying, I do not follow my own trading plan. I do not follow my own trading plan. I could have gotten in here, but I didn't. I got in the markets, but then I got out too quickly, or I got in the markets, I was on side and then I kept holding and then the markets reversed and then I took a loss. Like all of these things are related to emotional management. You need to have confidence in your ability to execute. You need to have high self-esteem for yourself when trading in the markets, and you need to have the emotional support of your family and your friends and the important people in your life in order to do this properly. And then last but not least, you must be disciplined as well. Stress management. So stress management equals risk management, and when good traders fail, it's often because they are stressed, right? So you never want to put yourself in a position where you are feeling stress. A good example here is like financial stress, right? You don't want to be you don't want to be approaching the markets you don't want to be approaching the markets or trading in the markets because you need money, right? Like you don't want to be in that position where if you don't make, $500 from this trade, you will not be able to pay your bills, you'll not be able to pay your rent, you'll not be able to pay your car payments. That is a bad position to be in. And if any of you are in this position right now, I would say stop trading immediately, right? Get your financial house in order first before you approach the markets. Never trade the markets with money that you cannot afford to lose, because when you're trading with money you cannot afford to lose, it adds an additional layer of stress to a game that is already very stressful. Okay, and there's many other forms of stress. You can get stress from your relationships, stress from your kids not doing well, stress from work, things like that. And there are many different types of coping mechanisms that we can look at to help us manage a lot of these stress, so that when we approach trading, we can trade with the most clearest, calmest mind set available and approach the markets just from that perspective. So the four causes of stress. So you have the loss of control, the unpredictability, your ego, and novelty. So, loss of control. Traders often want more control over their lives, and this is not uncommon to hear that people who are drawn to trading are typically the people who are entrepreneurs themselves, right? And for guys like Luke, I remember when speaking with you initially that you do own your own business. Is that correct?
Okay.
Yeah, so perfect, right? So you're very I'm pretty sure you're very familiar with this concept of being in control and wanting more control over how you dictate your life, correct?
For sure, absolutely.
Yeah. And so this is one of the common things that leads to stress in some people is that people who are typically working 9 to 5 jobs do not have this level of control over their lives, and it adds to a certain level of stress. Those who are the opposite of this, or those who are have the ability to take control of their lives and start their own business or whatnot, can understand that they are really in control of their lives, and this is something that they truly enjoy, even though there's levels of risk associated with it. Irrational situations can be stressful. So, irrational situations in the markets, for example, some traders are not able to trade news releases and things like that. Sometimes a news headline comes across the wire and we get caught up with a position that we're in, and we are out of our position because the markets move very quickly based on the news headlines that just hit the wires. And because of this, we taking a big loss because we weren't anticipating this to happen. But the irrationalities of the markets made us lose control of the situation. Okay. Not having a clear idea of when to exit a losing position can be stressful. So some traders that I know, I've seen them because of their stubbornness do not get out of trades in which they are offside. They'll typically hold on to a trade and say the markets will reverse, the markets will reverse, and when the markets reverse, I will get out at break even. And sometimes that works, but sometimes they get burnt from doing that and holding positions on much longer than intended, and they take larger losses than they intended to, and that loss of control itself can lead to additional stress. Must have a clear idea of when to cut losses. So this is something that will help you keep you in control, and this is something that I always focus on when I talk to new traders, is that I always say when you get in a trade, the first thing you should think of is if you are wrong, where do you get out of the trade, right? You always plan your exits first in the event of an emergency so that you can dump your trades just in case something bad went wrong with your analysis, right? Having the ability to step into a position with a predetermined idea of when to cut your losses will allow you to remain within control of trading in the markets, right? And this is something that we all must work on. And lastly, it is better to get out entirely rather than to reduce size, right? So this goes to the concept of sizing up and sizing down. We always talk about the idea of that when you're on side in a position and it's moving in your direction, momentum is good. You're reaping the rewards, and you're on the right side of the market, and the market is trending. You want to add more, add more, add more as you're on side. That's the idea of scaling in. However, some people may do the opposite, and this may not be optimal. And what I mean by doing the opposite is that instead of scaling in or scaling out of a position, some traders will do the exact opposite. They will have a losing position and they will scale in or scale out of a losing position, right? And what I mean by that is that, you're offside in a position and you decide to double down, or you decide to cut half of your losses rather than all of your losses. And a lot of times that is not the most optimal way to approach a trade, right? When you're approaching a trade, it's better to approach the trade from the idea of scaling in and scaling out of positions which you're in the green, and not doing scaling in techniques or scaling out techniques when you are in the red. Unpredictability. So markets are inherently unpredictable, right? I think we can all agree to this. Yes? Yes, are you guys still there?
Yeah, I said yes.
Okay. Yeah, sorry, I wasn't able to hear you, Luke, but yes. So the idea of the unpredictability in the markets is it's very, I say, well known, because if it wasn't well known, then we'd all be making millions and millions of dollars from trading within the markets, correct? So
Yeah.
that is why to say the market is inherently unpredictable is a valid statement. And because of this, we can mitigate this once we come to terms with the unpredictability nature of the markets by understanding certain techniques to help us bring sense to some predictability in the markets. And we do this by understanding macros and fundamentals. So the uh, macroeconomic situation of an economy, understanding what's going on in the central banks, understanding what's going on in the markets overall, understanding what's going on within the companies that you trade. This is all referring to understanding the macros and the fundamentals, and it helps to mitigate certain levels of unpredictability within the markets. In fact, it may lead to the opposite, and give you confidence to the predictability of a move in the markets, even though that predictability may not be 100% probable, but it would lead to higher odds. If you're able to understand this, you can mitigate it. The next thing is technicals and indicators. So using technical levels and indicate and technical indicators. Again, this will help us make sense of what's going on in the markets by giving us ideas of where we can expect the markets to bounce off of certain price levels. Um, we can get an idea of when the markets will be exhibiting trends using various indicators, exhibiting high levels of volatility, strange or anomalistic volume behaviors happening in the markets. These are all things that can be mitigated if we understand technicals and indicators. Account for volatility. So we can mitigate unpredictability by accounting for volatility, right? And what are some of the most volatile time frames for trading? Obviously, at the market opening, we can experience heightened level of volatility, and because of this, we can mitigate this level of unpredictability by not trading the opening, right? It's a very simple strategy that will allow us to avoid unpredictable behaviors just by knowing when volatility will pick up, and putting as many facts together as possible to increase profitable probabilities. So this again, I would say, boils down to understanding of the macro fundamentals very strong, understanding technicals very strong, understanding risk and reward, right? This here will all allow us to increase our profit probability by understanding all of these factors that are related to trading. Okay. Adhering to a strategy proven over time. Again, this is something that is difficult to create, but over time you are able to identify certain patterns in the markets, certain techniques in the markets that will absolutely work for you. And so that's why it requires a certain level of um, certain level of experience within the markets in order to be able to do it properly. Okay. And then lastly, discipline begets intuition. So being disciplined is always, always, always much, much better than to be trading with intuition. Ego. So ego is a sense of self-esteem, self-importance, self-pride. Ego risk in trading is revenge trading. I was guilty of this before, and I'm sure all new traders are guilty of this. I'm pretty sure, Luke, you've probably done quite a bit of revenge trading in your days.
Yeah, and it never works.
Yeah, yeah, exactly. Revenge trading never ever works. Revenge trading, in fact, is probably the quickest way to blow up your account, right? So we have to keep that in check. And a lot of times when we look at the underlying roots of revenge trading, it all boils down to our ego, our ability to say that we were wrong on a trade because we are a little bit too stubborn, which is the next point. Stubbornness, right? So stubbornness is another one that kills traders, like especially when you're offside and you're holding a position offside too much, and you don't want to get out of that position because getting out of that position basically means that you have just taken a loss, right? So stubbornness needs to be kept in check if we want to trade properly, and the inability to cut a loss, right? So again, back to my example of not being able to cut a loss or holding on to a trade offside too much because we are too stubborn, because we don't want to take a loss, because our ego won't allow us to do it. All right. Any examples of this that you guys want to share?
No, I really like to do though is to always set a task. If you're in front of your monitor,
Okay.
but I don't know, for people myself, it works.
Uh-huh.
So less stress if I have a line set, and no matter what, if it reaches it, it's well. So
Correct. Correct. So those are all very good ways to mitigate that as much as possible. All right. So another way to mitigate this is to follow your trading plan, right? Concentrate on setups, profit targets, and stop loss. What do you know? I always mention this. Concentrate on the trade setups. Have proper risk reward. Cut your losses if you're wrong, right? This should be turned into like a first grade jingle so that you can easily remember what are the biggest pitfalls of trading are and how to recite this jingle whenever you start trading. Okay. React deterministically, all right? So again, have a clear plan within your trade and focus on the trade setups and focus on your profit targets with distinct levels to get out of your entries, and have a stop loss in mind before you even set up any of this. Okay. Novelty. So, stress can arise in new situations. As we all know in life, as adults, we can experience stress from many, many different forms and many different avenues. Fortunately, it is rare to see completely new market conditions when it comes to trading, especially if you've been trading for a while. Now, for new traders have difficulty of understanding when the market has shifted, when a bull market has shifted, and now that market has become a bear market. Right? When I used to trade macro data, we used to have a saying that in a bull market, good data would be good for the markets, and in a bear market, good data would be bad for the markets. right? And the reason being is because when we analyze financial markets, especially when you're analyzing it from a macro perspective and from an interest rate perspective, an economy coming out of recession, which experiences good macroeconomic data, that data that is good will have a positive impact on an economy. However, when the bull run in the market gets to a heightened level in which the market can no longer be sustained, good data in the economy at that point begins to have negative effects on the economy. And it has negative effects on the economy because the central banks are more likely to increase interest rates. And over time, rates increasing aggressively and faster will have the opposite effect on the markets. So good data leads to an overheating economy, leads to an expectation of higher increases in interest rates, which then has the opposite effects on the markets. Okay. Study a new asset, understand them from a macro level, from a technical perspective, intuitively. Again, this is why I always ask you to look at more than one product because something may be easy to trade during this market environment, but that same product may become more difficult to trade when the market conditions have changed. And so you should be able to quickly switch from from different trading strategies and apply them very quickly on the whim. And that's what makes good traders from bad traders. Okay? Increase confidence tremendously and avoid getting complacent. Okay, so some bad decisions caused by stress and poor emotional management. I'm pretty sure we have all done this before. These are all personal examples here. When I first started trading, I was offside and I was too stubborn. I knew the markets were coming back. I knew the fundamentals really well, and the fundamentals hold true. So, guess what happens? I double down. I double down my position, and it didn't go well at all, right? So, these are some of the decisions that are caused by stress and poor emotional management. Revenge trading. I remember when I first started trading, I would trade data quite a bit. I'd be a big data driven trader, and when I would trade data, because the volatility is so fast in the morning, you'd see the markets trading sideways into a data, and then boom, data would come out and it'd be something like this, right? And I would buy at the top, get shaken out of the markets, sell at the bottom, get shaken out of the markets, buy at the top again, get shaken out when the markets reverse, and by then I've taken, a 30-40% loss on my total account. And I realize I didn't know what I was doing. Right? And so this is how revenge trading can be very detrimental to traders, especially traders who are unable to manage their stress and emotions. So it's very, very important that you guys have coping mechanisms to help you overcome some of these issues. Okay, departing from your trading plan is a good way to lose money. Over trading is a good way to lose money. So hopefully you guys take the message here very, very seriously because honestly, I can tell you right now, you will not succeed in trading if you're doubling down, if you're revenge trading, if you divert away from your trading plan too much, or if you are over trading within the markets. Mitigation techniques. So, ways to get around this. Operant conditioning. So, remember when I told you earlier that the first time I started trading, my very first trade, I remember it vividly. I was trading the E-mini S&P 500. you know, the market was exhibiting an uptrend, and I decided to get long in the markets, and I bought a contract. And as I was in the position with an open position, I felt very anxious. My heart was racing, beating very fast. My hands were shaking, and I was obviously in a state of heightened stress because I was not used to this level of trading or this activity of trading. And over time, I had to overcome this state of mind, and I did this by conditioning. So I over time forced myself to sit in front of the screen, force myself for times on end, and I basically got to the point where I've become very at one with the markets for when I enter a position. I feel, very little emotions when I trade in the markets, and that's how I basically condition myself is to put myself through that level of stress and focus on not um, being anxious about seeing the results and letting the trades play out with a thought in my head of how the trade will play out. And that's how I was able to get over some of these emotional and stress levels by conditioning myself. Take note of your emotional state, so always be conscious, be consciously aware of your emotional state of mind. Focus on breathing techniques. So if anybody meditates or does yoga, um, this will be very common coping mechanism to help you with uh, with with managing stress is focusing on taking deep breaths or taking breaths from a consecutive time frame. So like you holding your breath in, taking your breath out, and doing it for every 10 seconds or every 5 seconds. 5 seconds breathing in, 5 seconds breathing out. These are all ways to help you with the coping mechanisms through breathing. All right. And the final way to do this is to reward yourself when you don't do these things or when you do these things, right? And you can do that by going for a run, treating yourself to your favorite drink, your favorite chocolate bar, something that is rewarding for yourself. Go do some yoga, go to the gym, any way you find that is a treat for yourself for exhibiting good behavior will help you to reinforce a lot of those um, a lot of those positive emotions and mitigate some of those negative ones. General tips for success. Stay out of markets that you don't understand. I can't stress this enough. I know, Luke, you are a Forex trader, so you're probably familiar with that market. Now you're looking into stocks, so you're probably a little bit more familiar with stocks. But if I were to tell you to go trade the 10-year US Treasury notes and you have no idea what you're doing and you jump head in, there's a very strong chance that you're going to lose money, right? Eric, same thing for you. If I tell you that, you know, uh, you were a good stock trader, and you've never traded options before, and I tell you, go buy me some options, Eric. Right? If you don't know what you're doing, that could be a recipe for disaster. So stay out of markets that you do not understand is the number one way to not lose money. Right? More general tips for success: buy the rumor, sell the news. Right? This is a very common trading mantra in which the market will typically react to rumors about what's going to happen and then they sell what actually happens, right? And this has a lot to do with the market expectation theories that we spoke about in the module number 5, I believe. Basic market expectation theory states that the markets will begin to price in new relevant information, whether or not it's true. they'll still price it into the asset right away. And by pricing it in, they can price it in positively and have the asset rise in value, or price it negatively and have the assets fall in value. And then when the actual news comes out, the opposite effects will happen. That's the entire idea of market expectation theory. More general tips for success, guys. Um, Expect thin markets to be more irrational. So, you don't want to be trading penny stocks. You don't want to be trading forex exotic forex pairings, because those are what we refer to as thin markets. They will lead to irrationalities. Don't take for granted the validity of news. I think this point here, is pretty much cemented in media and popular culture right now, especially with the Trump administration and the whole fake news scandal. Every day is fake news this, fake news that. Trump is doing this, Trump is doing that. You cannot tell what is real, what is fake nowadays. So don't take for granted how real news headlines can be. Okay? Is there something you wanted to add to this point, Luke?
Oh, oh, fine.
No? Do you agree with this?
Oh, yeah, for sure.
Yeah, so again, just to reiterate, like in today's market environment, we get our news from the internet, from newspapers, from TV, and what's to say any of these news outlets are trustworthy, or if they do not have an inherent bias themselves, right? And so the validity of such news is always questionable, and do not be naive to think that everything you see on TV is in fact what it is. Okay. Always read in between the lines, right? Which is the next point. And understand how to trade with small capital versus how to trade with large capital, right? Um, and a lot of people that I know make this mistake. When people first start trading, they may have one or two trades on a demo account or one or two trades on a real account, and they think trading is easy. So what do? They go borrow money, they put in their savings, and they fund a large trading account, and then over time they lose all that money. Right? So do not, by at all means, underestimate the difficulties of trading, especially trading with large capital. Because trading with large capital is much different. You have more at stake. You have more, financial responsibilities at stake versus trading with small capital. But a lot of times, people who trade with small capital think that they're not able to compound their gains, they're not able to make meaningful profits because their capital is small. And these are some of the largest complaints that people will have when trading. Okay, so tips for trading with small capital: treat it like hundreds of millions of dollars. Okay, what this basically means is that when you're trading a $1,000, $2,000, $100, $500, or even $5,000 account, right? You have to treat it as if it was a large sum of money. Because if you never treat it like it's a large sum of money, you may not be able to get to a level where you are able to trade large sums of money and manage it properly. You must protect capital at all costs, right? We do not want to lose. We want to apply good risk management parameters and ensure that everything we do is protected. So our capital is protected as much as possible. Be parsimonious with trading, right? So this means do not trade too much. Do not overtrade. We want to trade when the opportunity presents us with high probability trades, or what I like to call free money trade. Right? This is what we want to look for. We want to look for the free money trade where the possibility of making money is extremely high, extremely easy. Tips trading with large capital. Don't think the account is inexhaustible. meaning that just because I have 100,000 or $1 million or $1 billion trading account, I can take large losses and and always make them back, right? That again leads to a lot of fallacies and a lot of bad trading habits. Resist the temptation to simply replenish the account, right? What is meant by this is that we don't want to get into our mindset that every time we lose money, we can just simply add more money back to the account and hit the reset button, right? We want to trade the capital as if it is our own capital, our very own, our all the money that we have, and that there is no way we can constantly re-adding more money back into the account. Resist the temptation to overtrade, right? So just because you have a lot of money doesn't mean you should be trading a lot or having a lot of positions on, right? We want to be sniping good trades with large size when we're trading with large capital. And only trade when there is free money at first anyways. So again, back to the rule of trading with small capital, we only want to be focusing on the markets and trading in markets when the opportunity leads to high chance of making money. So pitfalls, what happens when you're underwater? We must consider the overall cost of the trade, the impact on your account, the opportunity cost of margin on making other trades, the time frames on trades, right? And this usually ties to those who are stuck in a position. I know in the Toro Trading Challenge, we're only day trading the market, so we must close a lot of our positions by the end of the day. However, an example of this is that, let's say, for example, if you have a $100,000 trading account in the Toro Challenge, and you're trading during the day, and you're buying 1,000 shares of MU, which is trading at like, let's say it's trading at like $75 a share. If you're buying 1,000 shares of that, that's $75,000 in buying power that you have locked up in one stock. And you look over at another stock that is exhibiting a trade setup that you feel will lead to great risk reward opportunity, but you are unable to capitalize on that trade because you are all locked up in your capital. And so there's an opportunity cost associated with it because you have your money tied in one share or one company. More tips for success. Find a trading buddy, optimally someone who has a different strength than you. For example, one person is good at technicals, should be paired up with somebody who's strong with fundamentals. And a real life example is that BlackRock Capital, one of the largest trading firms in the world, money management firms in the world, uses this type of system in which they pair two discretionary traders together. One is more savvy with charts, and the other is probably more savvy with fundamentals or price action. And they work together to come up with proper trading ideas that will help them capitalize in the markets. Now, because a lot of you are trading from home, this may be a little bit difficult for you, but this is why we have the chat rooms, and this is why we encourage you to join the chat rooms, is so that you can get additional opinions on things related to the stock that you are trading, so that you can have a better idea of what's going on and make better judgments. So risk refers to um, situations for which we have no control. It's probability versus possibility. Think of the markets as a game of probabilities, right? Um, That's how you should always be approaching trades. If you talk to me a lot, I always analyze the markets from a probabilities perspective. What are the odds that the market is going to go up? What are the odds that the market's going to break this level? What are the odds the market will go back to your entry price? Always, always, always think in terms of probabilities, and from there we can assess the risk to our trades. So exposure to risk, source of risk that affects a position. So you have the basis risk. The basis risk is the difference between the spot price and the futures expiration price. The basis risk affects hedging. A lot of times, you have the physical market for an asset, and then you have a futures market for an asset. The price discrepancy between those two is known as the basis risk, and you have a lot of hedgers, especially in markets like oil, where you have oil futures contracts, but then you also have a physical inherent demand for oil. This leads to a lot of basis risk, and they can result in disproportionate hedging, difference in price between the assets to be hedged and the hedge, different contract expirations and whatnot will lead to all types of risks associated with the spread between a spot pricing of an asset and the futures pricing of an asset. Now, that is just an example of the risk. This style of trading does lead to opportunities as well. When it comes to that opportunity, that's often referred to as arbitrage trading. Arbitrage trading, where you're trading the spread. In this case, is a spread between a spot price contract and a futures price contract. All right. Have I lost you guys there on the basis risk or the technicalities of spot price and futures pricing?
I'm just wondering, are we supposed to pay attention to futures then?
I'm sorry, can you repeat that, Luke? I'm having a little bit difficulty hearing you.
I'm saying, are we supposed to pay attention to futures as well?
It's a very, very good question. So, in the futures market, there's a symbol known as the ES, right? It's also called the E mini. Have you heard of this contract before, Luke?
Oh,
No. So the E mini is essentially the futures contract for the SPY, right? And the SPY is equal to the S&P 500. Correct?
yeah. So I should pull the ES just beside the sky at all times.
I would say yes. Yes and no. Right, and I do talk about this in one of the upcoming modules. I believe it's the module 10, I believe. But the E mini, what's significant about this is that the E mini contract, the ES, which is the symbol, if you go on TradingView and you type in ES or E mini, you'll be able to find it. It's the futures contract for the spot. What's significant about this is that it trades 23 hours a day, whereas the SPY trades from 9:30, oops, 9:30 to 4. Correct? You following?
Yeah.
Okay.
Notice that ES, what came up is Eversource Energy.
Give me 1 second here. Type in. Are you on TradingView?
Yeah.
Okay. Type in ES and you should see S&P 500 E-minis futures. If you don't see it, type in all. Like at the top, you should see all. Click on all.
No, I just typed in ES, in the box where you look for any stocks,
Yeah.
but I don't see
Are
where
you on the
all
Haywood or are you on TradingView?
things you.
TradingView? Okay, so yeah, so in TradingView, in the search bar at the top of the chart, you just type in ES, and when you see the drop down bar, it should say all stocks, futures, forex, CFDs. Do you see that?
Oh yeah, yeah.
Yeah, so click all.
Oh, I see it now. Okay.
Yeah, so you'll see if you click on E-mini S&P 500, another drop down thing will show up, and what you want to do is you want to click on ES one exclamation mark.
There you go. I got it.
Okay, you got it?
Yeah.
Okay, perfect. So let me explain this a little bit for you. So the E-mini S&P 500 futures contract is a contract that trades out of Chicago, and it is a futures contract with an expiration date for the underlying, and the underlying is the SPY, right? It's all the companies within the SPY. Okay. Now, what makes this significant is that because it trades 23 hours a day, it reacts to news that gets released at like 7, 8, 9 p.m. at night. Let's say, for example, if Donald Trump were to come out and make a comment about the economy at 8 p.m. at night, the e-mini will react to this. Okay. And let's say if those comments were
Right.
negative and that caused the stock market to drop in value, the e-mini would sell off first at night. Okay. Come morning time, when the SPY, which is a composition made up of the E-mini, opens for trading, what do you think is going to happen to the SPY? It's going to open with a gap down,
So reflect.
right? Because the futures was negatively impacted by the Trump comments at night, the previous night. The next day, when the markets open, the SPY will gap down, reflecting what has happened to the E-mini. Okay? And I'll explain that. Don't worry if this is a little bit complex right now. I'll explain this concept when we get to that module where we look at correlations between various markets. This is a topic of inter-market correlations, and right now it may be a little bit too advanced, but there is a futures market for contracts linked to the S&P 500, and these contracts essentially lead the SPY and the S&P 500 because they trade 23 hours a day. Okay, and I think I'll just leave it at that because it could get very complex. I mean, this could be another 2 hour discussion about how that happens. But in general, that's the idea. And so, to answer your question, should you look at the E-mini when trading? I wouldn't look at the E-mini when trading throughout the day. I would look at the SPY because it's essentially the same thing. However, I would look at the E-mini in the morning. So pre 9:30 stock market opening, I would look at the E-mini to get a sense of whether the E-mini is trading up or trading down. Based off of that, I can tell whether or not the SPY will open up or open down. And based off of that, I can tell whether stocks like Alibaba, Facebook, MU, Roku, Western Digital, or whatnot will either open up or open down. Okay? All right, guys?
Okay.
Yeah, so I promise we will go back to this subject again and we'll make more sense of it. But it's a little bit complex and it does require quite a bit of explanation to do. But for now, if you guys just monitor the SPY prior to the stock market opening, you will get a sense. Sorry, if you monitor the ES prior to the stock market opening, you will get a sense for what's going on with the SPY. Okay, and the SPY and the E-minis are essentially the same product. If you overlay and compare them on a chart, you'll notice that they move in lockstep. All right. So market risk. So sensitivity to the market as a whole. Example, stocks being sensitive to broader indexes. So again, this is an example of market risk. This is why we look at indexes, because the indexes will affect stocks and stocks will be sensitive to the broader indexes. Mitigation, consider diversification. Derivative credit risk, so default exposure, pre-settlement risk, the amount that may be owned by a default party on a defaulted derivative transactions, functions of a credit risk or a market risk, settlement exposure, risk associated with payments in different currencies. These are all levels of credit risk or derivative credit risk. And for the most part, this here will affect more of the futures market, and they won't directly affect the stocks that you typically trade. All right, they will. If they do, it will be more of an indirect implication. Exchange traded versus OTC. So exchange traded markets mitigate risk by deposits and margins and regulations. Right. So this is why we trade on exchanges. OTC or over the counter, they are less regulated. Traders must assess the credit worthiness of the dealers, and so this also becomes a level of risk that we must look at when trading in the markets. Liquidity risk, one of the most underappreciated source of risk. Liquidity can lead to financial crisis. Example, the flash crash of 2010. Uh, I'm going to send you a link to the video where the markets experienced a flash crash. Actually, just give me 1 second here. I think I have the link here. So, so here I'm gonna send you this link. I'm gonna post this link right here, guys. You can watch this after the class, but this is an example of the markets crashing. The announcer is announcing the S&P 500 futures contracts, and as the market is crashing, you can see the markets just gapping, and breaking through price levels. That's because there is no liquidity, meaning that there is no counterparty to the trade at those specific price, so the next price level just keeps going lower and lower. All right, could result in getting filled at undesirable prices. So that's a very common liquidity risk. Operation risk, risks that arise from a company's ordinary business activities. I'm sure as a business owner, you're very aware of these operational risks. So examples include lawsuits, data breaches, fraud risks, personnel problems, business model risk, etc. All of these things, as a business owner or as an entrepreneur, you will be very aware of this type of risk associated in the markets. Sector risk. So risk can be endemic to a sector as a whole. Example, transportation industry and price of oil. They typically affect one another. As oil prices rises, cost of transportation increases, and the cost of everything increases, which leads to inflation, and vice versa. Tech sector and immigration. So you get a lot of you get a lot of tech savvy people from China and India who are taking over places such as like San Francisco because they're high level of intelligence in in the tech sector. And financial sector and regulations. So, like financial sector and regulations can be impacted. A good example of this is the banks and their prop trading firms trading clients' capital, which led to the 2008 2009 financial crisis, or not lead to it, not the direct cause, but it did help exacerbate the problem. And because of this, regulators came out with the Dodd-Frank Act. The Dodd-Frank Act was essentially a regulatory um, clause that that did not allow banks to prop trade investors' capital or capital they received from clients. Applied risk management. So differs by asset and asset classes. It can be depend on various things such as volatility, market levels, news, volatility. So we want to avoid entering choppy markets. Difficult to determine exit and entry prices. It's better to look for consolidation. Chart patterns increase win rate probabilities. So some examples of this include here is an example of why we don't want to trade in choppy patterns because all of these choppy trading patterns here are very erratic, right? So we don't want to be involved in markets like this. We want to see markets where the volatility is much tighter, right? Again, here too volatile in this specific range here, right? It's hard to identify which way the market is going. We want to look for areas here where the market begins to consolidate as an entry price or an entry point, right? And a little bonus here after this period of volatility, right? We get this little bull wedge here in the market which leads to that breakout. Capital management. So intentions, make trades, limitation, capital. So how to allocate funds to our trades. Excuse me 1 second.
You are now muted. You are now unmuted.
I'm sorry about that. I had to get a drink of water. Anyway, so levels. Look for rejections of levels, especially into vacuum areas. We want to use neighboring levels to assign profit targets and stop losses. We want to use effective risk management. So this is something that I always discuss with you guys, and I've discussed this with you guys quite a bit. And I always go over this as over and over, is that when you trade, you want to effectively manage your risk. And how do you do that? You limit your allowable daily loss to 1/3 of your average daily gain, right? So what does that mean? That means Luke, if today you pocketed $14, your average daily loss should be about $4.50. It sounds quite small, correct?
Yeah.
Sounds quite small, so that's why I'm hoping you would increase your profit target, right? You want to increase your profit target to making about $200, $300, $400 a day, and that way you can limit your average daily loss to about $100 a trade or over $100 a trade. Okay. Risk no more than 2% of your total account on a particular trade, right? So this is something that Haywood actually designed this into the system. So if you remember the overall drawdown, the total maximum drawdown in the Toro challenge, do you remember how much is that?
Like 3,000?
It's 3%, right? So in the Toro challenge, you cannot have touch a maximum drawdown of 3,000, right? For the entire challenge, right? On a single day, do you remember?
It's 500, but we want to do 450.
Exactly. It's 500, but we are limiting ourselves to 450. If you want to use the system, I can ask our trade support team to actually have you flat out at 450. That way you'll never risk that touching 500. All right, guys. So if you are
Okay.
If you want to do that, let me know, and I can ask the trade support guys to implement this on your account, and we'll have you close out at 450. So that way you technically never touch the 500 limit on the day. Okay.
Man,
All right. You never want to risk more than 1% of your account on a single trade. I think we've already established this that we are risking no more than 0.45% on a trade. Oh no, on the day. So that is a $450 loss on a $100,000 account, right? And on a single trade, out of the $450, if we're gonna risk on one trade, our risk would be about I would say about 1.2, 1.3, maybe even 1.4%, right? So 1.2% is about $120 per trade, right? And again, even down here, allow yourself no more than 3 to 5 trades a day. Why is that? Is because you remember how much round turns we need to do in the Toro challenge? 150 round turns, right? And if we have 3 month time for the trading day, that it basically equates to about 3 to 5 days to trade. Okay, and remember again, I remember that you wrote this down in your trading plan, Luke, that if you have 3 losing trades in a row, what's going to happen?
don't trade the next day.
Exactly, right? So that's why it's important to have effective risk management parameters when we set up ourselves to trade the markets, okay? And risk reward ratio, so profit targets and stop loss should not be set statistically or statically, sorry, right? Statically meaning that they should not be set at predetermined numbers. They should be set at levels, right? And sometimes those levels can lead to good risk reward. When we enter a trade, we always want to have at least a 3 to 1 reward to risk ratio, right? And when we enter trades, minimal we want is at least 2 to 1. But I would say sometimes because the market changes, sometimes we may have to settle with just a 1 to 1 risk reward. And that's okay too. I don't want you trading thinking that it is not okay to take a 1 to 1 risk reward because the markets can do this. You know, you're on side, you decide to enter. Um, you enter somewhere around there and you're only at um, you're only at about one of the ratios of your risk, and then the market pull begins to pull back, right? Well, sometimes it's better to exit with a profit than to exit with a loss, right? And so that's why sometimes it's better to exit with a 1 to 1 risk reward ratio than to exit with a losing position. Short squeezes. So short squeeze is a phenomenon in the markets that happens when traders are cutting their losses or taking their profits. Right? It's like, let's say, for example, when the market is rallying too much for an extended period of time, and you have you have a market that is tilted towards the buying side, right? And the market has extended too much. When you have some selling taking place, it will exacerbate all those buyers who are buying at high levels, and they will begin to exit out or take profits on their position. And this will cause to an abrupt drop in the markets very quickly. It's referred to as a short squeeze. It looks like buying activity or selling activity. It lacks conviction to continue the trend. It typically occurs when the market trend is in a bear trend and buying activity occurs at a level but is unsustained. Short squeeze susceptibility breached a new low. breach a strong level on the downside, risk heightens with low liquidity. And then last but not least, the conclusion for today's session. We always want to trade when the odds is in our favor. We never want to trade when the probabilities is less than 50-50. Always ensure that you're thinking in probabilities and always ensure that the probability is tilted towards your side. We want to cut your losses short, right? So the moment we feel that we're wrong on a trade, it's time to cut the loss and it's time to get out of the trade. We don't want to be stubborn. We don't want to be revenge trading. And we definitely do not want to double down on trades that we're offside in. We want to let our winners ride, but err on the side of caution. Always, always, always never get complacent and be too comfortable when you're trading in the markets. We do want to do your own analysis. This is very important. A lot of times I see traders who are just looking for tip, traders who are just looking for someone else to tell them what to do, right? That's a poor way to approach trading. We always want to trade with our own thoughts, our own analysis, right, and our own ideas, and be open-minded of other people's suggestions, open-minded of other people's opinions, but know that at the end of the day, we are responsible for our own trading. Beware of the masses of optimism and pessimism, right? And a lot of times when the markets become too optimistic or too pessimistic, that is when it is time to get out of the markets, right? If the market is too optimistic, if people are just too complacent, that is a time that is the time you want to start being cautious. That's the time you want to start thinking about taking profits. And last but not least, adapt to changing market conditions. Right? The markets will change all the time. Markets move in big cycles, and especially for new traders who have never traded through a rate hiking cycle where the interest rate environment is going up, that affects the stock market by capping the top and putting downward pressure in the stock markets to collapse. Um, Trading when interest rates are being cut, when interest rates get cut aggressively, that leads to overvaluations in the stock market. And we can take a look at the 2008 2009 financial crisis as an example. Pre 2008 2009, we were in a rate tightening cycle which caused the stock markets to peter off. And as rates got too high, that caused a recession, and the stock markets basically collapsed from there. Interest rates started getting slashed aggressively, and as a result, they stayed at low levels for an extended period of time. During those low levels, the market environment condition changed, and stocks just kept rallying up, 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 and up. And so now, only now, we're beginning to see a period where rates have finally begun to pick up since the last financial crisis. And because of this, we are beginning to see a top in the markets as central bankers are signaling that more rate hikes are going to be coming. This will lead to more capping to the upside of the markets. As rate hikes begin to increase rapidly, that will essentially cause the markets to start coming off, right? And it's hard to say that you need to adapt to changing market environment and market conditions when many times people have only traded certain types of markets. If you never traded through a recession, then it's hard to understand how the markets will behave. If you never traded through a growth phase, then it's hard to say how the markets will react when you go through that phase. If you never traded through a crisis, if you never traded through 9/11, if you never traded through a presidency change, if you never traded through a currency collapse, if you never traded through war, if you never traded through natural disasters, then it's hard to say how the markets will react. But again, this is why you need to give yourself time to learn how to understand the markets, how to approach the markets, and how to gain experience in the markets so that when these conditions, these changing conditions, present themselves a second or a third time, you will be conscious of how to react to these environments. Okay, is there any questions, guys?
No,
You're
I'm
good,
good.
Luke? You're good? No questions at all? Okay.
Right
Uh,
now, like last time.
Eric, do you have any questions, Eric? Khalid? I just want to say that this module, I'm gonna be posting it on Vimeo right after this. Again, as always, I'm gonna be sending you the link, and I will also be sending you the PDF of this module so you guys can review it and go over it again. As always, I will be in the chat room for another 15 minutes, half hour. If you guys do have any questions, if not, it was a pleasure speaking with you. And being with you guys again today for our next class. This is very important for our next class. Um, it's going to be a trading session. So we're going to be doing a review and then we're going to be doing a trading session again. I know last time, Luke, we spoke that we said it was better if we could do it earlier. Ideally, I would like to trade with you guys earlier because the markets are actually moving. So if you guys can let me know if you'll be available to trade at maybe around 10 or 10:30, that would be great. Are you available to do that next Tuesday?
Yeah, 10 works for me.
10 works?
You are now muted.
Yes. Okay.
You are now
Um.
unmuted.
Okay. So I will. Okay, Eric, that's great. Khaled, I don't know if you're there, but I will send you guys out an email, guys, to remind you. If anything changes, please look out for any emails from me, letting you guys know. Other than that, if you have questions, type it here. If not, I will see you guys in the chat room, and we will continue trading again. Okay. Have a good one, everybody.
Question, coach.
Bye
A
now.
question, coach.
Oh, yeah, go ahead.
I don't think you ever sent us module 6 as a